If you've ever thought about investing in real estate or you're already in the game, this is the video you don't want to skip. We're talking about some huge wins just signed into law last month under the new One Big Beautiful Bill Act. Now that the dust has settled, I'm breaking down what this bill means for real estate investors like you and me, how to take advantage of these changes, and best of all, how to stack them for even more savings. The goal? Generational wealth building through real estate done smart. Hi friends, welcome back to the channel. I am so excited about this one today. If you followed me for any length of time, you know that I believe in the absolute power of real estate investing to change the trajectory of your life today and in your retirement years. Investing in real estate the right way brings you more money, more time with your loved ones, and the flexibility in your life to live it the way you want. But what does doing it the right way look like? Well, just making the money isn't enough. You have to know what it takes to keep more of it for the purpose of reinvesting it to build up that wealth. And who do you suppose is the biggest taker of your hard-earned money? Well, Uncle Sam, of course. That is why the passing of the One Big Beautiful Bill Act last month is such a cause for celebration for real estate investors. And many economic minds are already making projections on the increase in real estate activity in the coming months. So get ready. The fact of the matter is that this bill contains quite a bit focused on saving business owners and investors serious money on their taxes. Did you know that it is estimated that the average American will pay over $500,000 in taxes throughout their lifetime? That translates to an average of 1/3 of your lifetime earnings being handed over to some government entity in the form of federal and state income taxes, property taxes, sales taxes, etc. Now, don't get me wrong, I believe in paying taxes to keep our government services intact. What I don't believe in is being average. And thanks to our generous tax code and bills like the One Big Beautiful Bill Act that are proposed and passed every year, you don't have to fork over 1/3 of your hard-earned money. The truth of the matter is that our tax code rewards investment in our economy through businesses and real estate deductions and punishes W-2 employees through higher taxes. So let's dig into what is coming down the pike through this new bill and, more importantly, how you can benefit from it as a real estate investor. Let's start with one of the biggest victories, the now permanent Qualified Business Income Deduction, known for the last 8 years as the QBI Deduction. This 20% deduction for business owners was brought about by the Tax Cut and Jobs Act of 2017 and was slated to end this year. But it's back, and it's back for good. And all types of business owners, from sole proprietors to partnerships and even LLCs, qualify so long as their business income is passed through their business and claimed on their personal tax return. This 20% deduction comes off the net income or profit earned by your business. And best of all, this deduction can be stacked to all your businesses, including your rental property business. So even if you're a W-2 employee working an 8-to-5 job, if you have at least one rental that you run as a business, you can take this deduction. So where do you sign up? First, speak with your accountant. They will give you the exact guidelines that you must meet to qualify your rental as a business. But think maintaining separate financial records for that property, spending at least 250 hours annually on your property, and keeping detailed records of how that time was spent and when. Not only are these guidelines within your means, but in all honesty, these are things that you should be doing anyway to ensure the long-term return on any investment property. 20% off is great, but here's the kicker. If you're a high-income earner, $197,000 for single filers, $394,000 for married filing jointly, this deduction starts to phase out. So working with a tax strategist is key to maximize this benefit. And they aggregate your income across all your businesses. So if you have multiple business income streams and one of them takes a loss, that loss is applied to the other business income that's in the positive. Still, anything that reduces the amount of income you have to pay taxes on is an amazing perk of being a rental property owner. Next up, something we almost lost but didn't: the mortgage interest deduction for investment properties. Mortgage interest, especially at the beginning of your loan, can single-handedly be one of your biggest tax deductions for both your personal residence and your investment properties. primarily because interest is typically front-loaded. When the 2017 Tax Cuts and Jobs Act slashed the amount of mortgage interest you could deduct on personal residences to only the first $750,000, many homeowners lost a major benefit. But here's the good news for investors. The recent One Big Beautiful Bill Act preserves and strengthens the full deduction for mortgage interest on rental properties without the limits placed on personal residences. Whether you finance your rental with a conventional loan, pull equity with a HELOC, or even refinance with a cash-out investment loan, the interest is still 100% deductible as long as the loan is tied to the income-producing property. And even better, if you pull a HELOC on your personal residence with the intent to purchase or improve a rental property, that interest is also fully deductible. But wait, there's more. Starting in 2026, this stipulation is scheduled to be eliminated. That means in 2026 and beyond, the interest paid may still qualify for deduction even if you allocate the loan proceeds toward general operating expenses, repairs and maintenance, or consolidating business debts. If you're holding a 3% interest rate on your rental, you probably didn't give this one much thought. But as we are staring down rates in the 7% range, keeping this deduction in place for your future investment is crucial. The mortgage interest deduction lets you keep leveraging real estate to grow your portfolio without getting crushed at tax time. If you have a $400,000 loan at 7%, that's nearly $28,000 in interest your CPA can use to offset your income. Speaking of winning, bonus depreciation is back at 100%, and unlike the last time around, it will stay at 100% for every single improvement that qualifies. Bonus depreciation was first introduced in the Tax Cuts and Jobs Act of 2017. It started strong at 100% and gradually dwindled to the 40% available for 2025. I want to take a minute quickly and differentiate straight depreciation from bonus depreciation. Uncle Sam allows you to take a depreciation deduction on any rental you buy. Think of it as a consolation prize for your property getting 1 year older. You can take this deduction every year for 27.5 years for a residential property and 39.5 for a commercial one. Note, this does not apply to your personal residence. The easiest way to calculate this deduction is take the total value of the improvements or the buildings and divide it by the 27.5 years. The bare land under the building does not factor in. You can't depreciate land. On the property we spoke about earlier, you might have a $10,000 deduction in regular depreciation just for purchasing that $400,000 investment property. Not bad, especially when you combine that with the $28,000 mortgage interest deduction. Now, bonus depreciation is calculated slightly different because Uncle Sam is trying to reward you for improving your asset. In this case, you are looking for the assets with a useful life of 20 years or less. Think HVAC systems, flooring, landscaping, carpet. In other words, the property improvements that make up the property. Bonus depreciation supercharges your tax savings by letting you write off the full cost of improvements made to your investment in year one. Let's say you buy a $400,000 rental and you spend $50,000 on new appliances, a new HVAC system, and all new flooring. Bonus depreciation lets you deduct that entire $50,000 right away instead of spreading it over several years. Further, you can pair bonus depreciation with a cost segregation study to increase the depreciation deduction even more. A cost seg, as they are known, will let you break out portions of the rental like carpet, cabinets, and even landscaping to depreciate faster. Clearly, these items will wear out faster than the 27.5 years. Pretty slick. But here's the catch. First, this only applies to qualifying improvements. So please check with your CPA before spending money willy-nilly, thinking you will have a hefty deduction come tax time. Second, plan your exit from your investment carefully. You will face depreciation recapture when you sell the property. So, if you take a significant deduction up front, all that comes back when you sell. If you have not considered what your exit strategy from a rental property might look like, check out this video where I cover several options for you to explore. It can make a significant difference in how much money you get to keep in your pocket. Now, owning a business or rentals is hands down the best way to supercharge deductions to lower your tax liability. However, if you're a W-2 employee and want to get into the investment game, the One Big Beautiful Bill had some amazing perks to help get you there. These next three provisions are great strategies to use to help you save tax dollars that you can then funnel into buying your first investment. The first one is really geared toward high tax states like California and New York, but it can certainly help even in moderate tax states where you might own multiple properties. I'm talking about the SALT deduction, which allows you to deduct your state and local taxes from your personal tax return. The cap on that deduction just jumped from $10,000 to $40,000. Talk about an incentive to itemize. If you live in a high tax state or own high dollar personal and secondary residences, you want to look at this deduction compared to the standard deduction to see if itemizing makes sense. But beware, this cap increase is temporary and may revert in 2030. If you're an investor or plan to be, don't build long-term projections on a short-term provision. Next up, for my waitresses, hairstylists, nail techs, bartenders, and even my Uber drivers who want to get into the game. You can now exclude up to $25,000 earned on tips from your taxable income. So while you still have to report this income, you don't have to pay any tax on it. Why this helps? Well, in the past, the incentive to report any cash tips was, let's just say, not very strong, which means much of the money, while not taxed, was also not factored into your income for qualifying for a mortgage. I saw many people not able to qualify for a mortgage simply because a good portion of their income, unreported, came from tips. They had a good down payment, but their debt to income ratio just wasn't sufficient to get them qualified. With this new provision, not only do you not have to pay taxes on the first $25,000, but since it is reported, your income gets a nice boost for mortgage qualification purposes. The same goes for overtime. The limit on this one is lower at only $12,500 being excluded. But hey, every little bit helps. In the past, overtime was averaged over the last 2 years, meaning if you earned $10,000 in overtime in 1 year and only $5,000 in the second, you only got credit for $7,500, and you pay tax on all of it. With this new rule, so long as you stay before the $150,000 income threshold, you can count the full $15,000 as your limit is $12,500 per year. So if you're in one of these employment sectors where you earn tips or overtime, the One Big Beautiful Bill is here to help you save money on taxes while boosting your reported income. Use this to your advantage to buy your next property. Earlier we mentioned that a lot of these provisions can be stacked together neatly for even better results. So let's look at how that can work for you. The fact of the matter is that it all starts with buying that first rental property. You may or may not be in one of the tip or overtime income sectors. If you are, awesome. You have a new way to boost that income to qualify. If you're not, you can still take advantage of the increased SALT deduction. All of these provisions will help you keep more of your money out of Uncle Sam's grubby hands and ready for you to use on your next purchase. Once you make your purchase, get ready to really take advantage of the One Big Beautiful Bill. If you use any type of mortgage, you will get a 1098 form from your lender. Save that for tax time. If you buy your rental with a HELOC pulled on your personal residence, make sure you document carefully how that money was used to purchase or even improve a current rental. This will allow you to take the interest deduction even though that loan is not secured by your rental. Next, do yourself a favor and manage your rental like the business it is. That means keeping track of your income and expenses in separate bank accounts and documenting all of your expenses like repairs, maintenance, and even property management fees. It means tracking your travel and time spent on behalf of your business. Running your rental like this will enable you to qualify for the QBI deduction, which really is a wowzer when you consider that you can take an additional 20% after all your other expenses have been paid. Finally, because you track every expense and improvement, consider bonus depreciation when you invest in large ticket items for your rental. It might make sense to spend that extra money on putting on a new roof this year if you can depreciate the full amount against the income. Taking an extra $15,000 for a new roof on top of all the other stuff could be pretty advantageous. And even consider a cost segregation study. If you have a good year, being able to increase the deduction for things in your rental that wear out sooner could be super helpful as well. As you can see, combining these strategies can add up to significant savings on your personal tax return. And when the majority of your income is from a W-2, where you're looking at the standard deduction at best, these added deductions can make a world of a difference on how much money you give to Uncle Sam. Like I said, don't be average when there are so many provisions in our tax code that are designed to help you save more, invest more, be more. Well, friends, as I mentioned at the start of this video, building that rich life starts with keeping more of your money. And that starts with aggressively tackling your business expense. In this case, taxes. This One Big Beautiful Bill Act has a little tax reprieve for everyone. But real estate investors truly have the most to gain if they strategize correctly. Do yourself a favor. Click like and subscribe if you haven't already. Share this with all your investor friends and get on the phone with your tax advisor. Come tax season next April, you'll be glad you did. Thanks for watching and catch you on the next one.